let's dive straight in. So the first thing that we're going to be looking at is the new earnout provisions, just to bring everyone up to speed. An earnout is a situation where, say for example, in a business sale, the vendor and purchaser can't determine what the appropriate purchase price should be. Purchaser says, I think the business is worth $2 million. The vendor thinks, oh, I've got a couple of big contracts coming through in the next couple of years. I think it's worth $3 million. So what they do is decide, hey, we'll pay you $2 million now, and if you meet certain profit and revenue targets in the coming years, dollars. So that payment of that contingent amount is what is referred to as an earnout, and it's been the subject of some recent legislative change. The main reason for the legislative change is the Commissioner in 2007 put out a draft ruling up there on the screen, TR 2007-D10. As far as I'm aware, it's still in draft, and as you can see, it's been in draft for the better part of a decade, almost a full decade now. And what it did, just for the history, so it makes the legislative amendments make a little bit more sense, was the Commissioner said in his earnouts ruling that what happens is when you enter into that contract for $2 million plus $1 million down the track, that $2 million you have to bring to account now. You also have to bring to account the market value of the earnout. You have to get a valuer in and say, well, there's the potential for this $1 million to be paid. There's a risk that it might not. So the valuer comes in and says, I think the market value would be $800,000, assuming there's a 20% chance it might not get paid. And what the Commissioner then said was, you need to bring to account in this year $2.8 million. You get to apply your general discounts, small business concessions, and what have you. But down the track, the earnout, or that earnout right to the $1 million, is a separate asset to the assets you sold in your business. So on account of that, if you haven't held it for 12 months, or you get paid that earnout within 12 months, you don't get to apply the general discount. In addition, you don't get any small business concessions because that earnout is not an active asset. It's not an asset that's connected with your business. So on that, you can end up with some pretty bad tax outcomes, and we'll discuss that in a little. But it's just that horrible treatment from the position that the Commissioner took that has led predominantly to these changes. But going through it, there was some criticisms throughout the profession that the Commissioner got it wrong, which is another reason it's been drafted since 2007. One of the key guys that pulled the Commissioner apart was Professor Chris Evans from the University of New South Wales. He's the co-author of the Thomson Reuters CGT handbook, and he was quite critical of the approach adopted by the Commissioner. So 2010, the Rudd government said, we're going to legislate to fix this problem. When they got booted out and the Abbott government took over, they said, yes, we're definitely going to fix this problem. And started this year, 25th of February, we finally got some legislation. So this legislation applies to all transactions that went from 24 April 2015. And let's get into a little bit of the nitty-gritty. So this is what it applies to. I won't go too much into the technical detail. Suffice to say that the legislation deems a look-through earnout or an earnout which the new as what you might expect, something that is a right to future benefits or future financial benefits, and you can't ascertain what they are immediately because it might not be paid, all those sorts of things. The new earnout provisions are only going to apply to disposal events, so A1 events, none of the other CGT events. The assets that you sell are going to need to be connected with business, obviously active assets. Probably the bigger things to be aware of are that in respect of earnouts, if your earnout can be paid more than 5 years after the year in which, or the end of the income year in which the initial sale went through, these new provisions don't apply. So you're stuck providing or stuck trying to apply the Commissioner's previous ruling and the horrible consequences that happen if and when the earnout gets paid. What I should say, these new earnout provisions take a prudent approach to dealing with earnout. So unlike the Commissioner's draft ruling, they effectively just allow you to go back and say, hey, I've got an earnout. This was inherently connected with the sale of the business asset. That business asset would have got general discounts, small business concessions, active asset discounts, all the rest of it, and allows you to go back, effectively amend any previous assessments up to that 5-year period, or 4-year period effectively, and also go back and remake decisions. So an example of that might be you're going back to that $2 million initial sale, $1 million earnout. You get paid that $1 million, you come back in there, you say, hey, fantastic, I've got an extra $1 million. I'm going to go back, I'm going to amend it, I now have a $3 million gain, go through the process again, general discount, small business concessions, active asset discount. But then if you contribute something to super on your behalf, you end up with a balance of say $250,000 or $200,000. You can then remake a choice to contribute that to say a spouse who was also a small business concession stakeholder at the time. So it's a very good way and a very prudent way of dealing with this, and probably the correct way of dealing with it, notwithstanding the Commissioner's draft ruling. The other things to be aware of, just out of all of this, is that, as you'd expect, the financial benefits need to be contingent on the economic performance of the assets that are sold that are the subject of the earnout. So whether or not business continues or the assets get transferred into a new business. Either way, subject to the financial benefit needs to be contingent on that economic performance. And then broadly, you just need to be dealing with each other at arm's length. So you can't use these new provisions to delay tax assessments. There need to be a genuine type arrangement. Again, the effect in terms of does mean is it allows the purchaser to go back and increase their cost base if the earnout is paid, in terms of the capital proceeds for the vendor. Again, they can go back and include those capital proceeds. They go back and include that additional earnout in their capital proceeds for the capital gains tax calculation, and again can go back and remake those choices. So if we have a look here, it's a little bit small, but if you can see, this is a bit of a comparison between the two, or how the previous ruling worked and how the new provisions work. So again, this is the $2 million, $1 million earnout. Under the previous tax ruling, you'd say have $2 million. You'd have a market value of the earnout, which is $1 million, assuming that 20% discount for uncertainty. That means you had to bring $2.8 million to account now. You had a general discount down to 1.4, assuming small business concessions applied in that situation. Active assets down to $700,000. There's a contribution of $500,000 to one of the CGT concession stakeholders, $200,000 to the concession stakeholder spouse, assuming again they have a small business participation percentage greater than 0. That leads to a nil tax assessment. Again, under the new provisions, you're only bringing into account $2 million now, and then you just make your decision. So in this situation, you don't have a $500,000 gain, which you contribute to the super or the CGT concession stakeholder would contribute. The trick comes in year 2. Under the Commissioner's ruling, he says, hey, because there's a difference between the cost base of the earnout that you brought to account last year and what you got paid, assuming dollars gets paid, I'm going to say you've made a capital gain this year of $200,000. Total gain $200,000. If it's less than 12 months, no general discount, because they're not active assets, no small business concessions. Therefore, you end up with, if it all goes to one person at the end of the day, $92,000 worth of income tax assessment. Whereas under these new provisions, they allow you to go back, retreat everything, remake decisions, and make further contributions say in respect of retirement exemption, and effectively keep your tax down to minimal. If you're going to go start applying the provisions, it's quite important to make sure that you do satisfy what is an earnout. If you don't satisfy what is an earnout, you're stuck back with TR 2017-10 and these sort of problems which can affect your business. So we'll now move on to the small business reconstruction relief. Quite a generous rollovers now being put in. The previous restructure type rollovers for these particular provisions are 328 sub G of the Income Tax Assessment Act 1997. The previous rollovers were right. It was quite very well catered toward pushing these new small business reconstruction reliefs are far broader than that. They allow you to pretty well transfer from whatever type of entity you are to whatever type of entity you might want, subject to meeting the eligibility criteria. They're to apply on and from 1 July 2016, and they apply not only in a capital gains tax sense, but they also apply to depreciating assets and also trading stock and revenue assets. Their overall purpose is to be able to let you change from one structure, for lack of a better word, to another structure in a tax neutral way. So effectively what happened, how these work is the transferor is deemed to have sold all of the assets to the transferee, the new company that you're restructuring into, at all of the assets relevant cost. The transferee is deemed to have acquired all of those assets at their relevant cost. So tax neutral. Some of the qualifying criteria. Entities, it's only available to small business entities. So currently that's an entity that has a annual turnover of $2 million or less, or something over from the entities and connected entities. But you will recall from the budget this year, Malcolm Turnbull has announced that there may in fact be a increase in the turnover test to $10 million. So that's going to potentially up these provisions to obviously see how, obviously it's going to be subject to who wins the election come 2 July, and also what the actual terms of the changes to the Tax Act are for that $2 to $10 million increase. But otherwise, probably getting back more into the qualifying criteria, one of the biggest things that they've got in there is the restructure needs to be a genuine business restructure. Being the federal government, they haven't actually provided us with a definition. What is a genuine business restructure? They're looking predominantly at scenarios and what they can glean from the factual circumstances surrounding the restructure. The explanatory memorandum, I think, suggests that if the business continues, the assets continues to be used in a business, and there's some discussions to that the structure that they restructured into was definitely the structure they were always meant to be in. If they had got the appropriate advice at the time, then they'll think it's a genuine business restructure. 3-year safe harbour provision, so much like corporate reconstructions for stamp duty. If you start disposing of assets that you've restructured after 3 years after the restructure, they're going to generally see that that's a genuine business restructure. By including this genuine business restructure, what they're at is, they don't want company restructure. Company has a buyer for a large asset. Company decides, hey, I'm going to restructure into a trust under these provisions. Immediately after the restructure, they flog the asset off, and then immediately get the general discount. There wasn't the general CGT discount, which wasn't otherwise available to the company. They're saying that those types of restructures are not going to be genuine restructures, and they won't necessarily accept that as a genuine restructure. Probably a more interesting situation might be where you have a client who decides to restructure to make them more attractive to a buyer. You might have a small mum and dad partnership that want to restructure into a company with the assumption that they're, say, an ASX listed company, and the ASX listed company would only be wanting to buy corporate entities so that they can appropriately consolidate them and the rest of it. You'd query whether or not that's a genuine restructure if it happened quite close to the acquisition date. The EM seems to say that that's probably not going to be a genuine restructure, but it might be more interesting to see what sort of guidance we get from the tax office, and what sort of guidance we might get if these provisions are ever challenged down the track. So going probably more into the nitty-gritty, as you'd expect, the ultimate economic ownership needs to stay the same. You can't use this as backdoor sale. Interestingly, the share also needs to stay the same, or the shares of the ultimate economic owners need to be the same. So if you've got three people in an equal partnership, you can't restructure into a company. Two of them have 50% between them, and the other one has a full 50%. Also, you can't play around, at least on the current reading, you can't play around with preference shares or classes of shares. If there are different rights between them, they all need to have the same rights, same proportion, and same type of interest in the entity. Eligible assets, again, active assets, usually only going to apply to a business type restructure. But again, those three types of assets, CGT assets, revenue assets, depreciating assets, and trading stock. So residency as well, we're only going to apply to Australian residents. We're not going to apply to international restructures in Australia, and it won't apply to exempt entities or complying super funds. So again, how we'll ultimately operate is in terms of CGT assets, cost base and reduced cost base will be acquired by the new entity. Pre-CGT assets, they're going to grandfather the pre-CGT account capital gains, obviously the 12 months in order to be able to claim the discount. That'll continue. Trading stock will be acquired at its cost, or been held for more than a year at the deemed value. Revenue assets at their tax cost, and depreciating assets at their depreciable value. The trick with these new provisions, I feel, are going to be making sure that the acquisition or the restructure from an income tax perspective is also not going to trigger any undue duty implications. We'll get onto the duty in a little bit, but following 1 July 2016, New South Wales, it seems as though something good for people in New South Wales. Queensland practitioners are still going to have to step through the duty issues to make sure that there's no horrendous duty assessments waiting in the wind if you do a restructure under these new provisions. The other thing to be aware of is that when you restructure into an entity with membership interests, the new membership interests are issued as consideration for the transfer. Right here, I pulled out the example from the explanatory memorandum to these new provisions. It was Edamame Proprietary Limited. It's transferring its Soy Source Trust as part of the overall genuine business restructure. It's got $1.5 million in assets, $1 million CGT asset, general CGT assets, $1 million, and depreciating assets with an adjustable value of $400,000, so $1.5 million. If they're issuing 10 units in the new trust, presumably in accordance with the shareholding, each one of those units is going to have a cost base of $150,000. There's that little calculation there. So, some Div 7A changes. It's rather innocuous in the budget speech and the budget papers, in fact. The wording that you see there on the screen is pretty much what was in the budget papers. There's going to be targeted amendments to improve the operation and administration of Division 7A, self-correction mechanisms for inadvertent breaches, and some safe harbour rules to provide some certainty. What they're actually getting at is in late 2014, Joe Hockey, when he was Treasurer, received post-implementation review of Division 7A from the Board of Taxation. There was a decent-sized document, 100 or so pages, with a stack of amendments as to how Div 7A should be reviewed and fixed and all the rest of it. What they're saying, what that particular paper was self-correction mechanisms, was that if, say, accountants or lawyers down the track stumble on a potential Div 7A problem, there's no requirement to rely on the general Commissioner's Discretion 109 RB of the 36 Act, which they thought was quite inflexible and quite difficult to go ahead to deal with, and the fact, probably more so, that it didn't encourage people to want to ring up the tax office and say, hey, I think I've got a Div 7A problem here, it's an honest mistake, can we fix it, and can you please just not apply any penalties or interest? Suggesting here, and what the Board of Taxation was suggesting, was that it's going to be a self-assessment type or self-correction type mechanism, where you can go back and so long as you've taken some reasonable care, there's a decent standard of care, and there's no complete ignoring of the Div 7A provisions, or there's no intent not to comply with them. There's not going to be any deemed dividends under Div 7A when you go back and take that corrective. When you go back and take corrective action, when they're talking about corrective action, they're really getting at is going back, realizing you've got a Div 7A problem, putting a proper loan agreement in place, secured or unsecured depending on the circumstances, and making any catch-up payments to bring you to make it as if you had always complied with Division 7A. The safe harbour provisions are really trying to get at the provisions in Div 7A that deal with the use of private company assets by shareholders and associates. That's really just putting in a formal arrangement for calculation of what the deemed dividend methods for calculating depreciating assets. An interest component plus whatever value got lost in depreciation, and then a particular formula for appreciating assets like holiday homes. So that's what that rather innocuous statement in the budget papers seem to be getting at. The other thing that's probably useful to bring out was that the Board of Taxation in their review suggested effectively a complete overhaul to how the current 7-year Div 7A loan arrangements work. Obviously secured and unsecured for each of those 7 and 25 years. What they're suggesting is a simplified operation of Div 7A, where there's no more 7 25-year loans. There's just a 10-year loan. There's a prescribed interest rate, which is the RBA's indicator lending rate. There's the strict requirements in 109N about written agreements and things like that. They're going to be pulled back, and it's more so just some evidence, either in writing or electronic means, that the parties intended the payment to in fact be a loan. And there's going to be that removal of the minimum yearly principal repayments, so that it's effectively at year 3 paid your interest at the prescribed rate, and the loan balance can't be more than 75% of the original loan. At year 5, same sort of thing. Interest, principal payments, and the loan balance can't be more than 50% of the original loan. You're at 25% and paid off. So it will be interesting to see if that change. This government seems to be more on the ball in terms of Div 7A changes of the Turnbull government than the Abbott hockey government. So we'll see how that all goes. We can all cross our fingers and hope for some simplification to Div 7A and how it currently operates. In terms of a bit of a duty update, New South Wales, they're set to abolish stamp duty on marketable securities, so unlisted units in unit trust and unlisted shares in companies that are registered in New South Wales. Mortgage duty going to be abolished. Mortgage duty, I think New South Wales is the only state in the country left imposing mortgage duty. They're also going to abolish stamp duty on transfer of business assets and a stamp duty on statutory licenses, so gaming licenses and things like that. They've said it before. They were going to do this, I believe, around 2012, 2013. That never happened. It's now currently set out in their legislation that this is when they're going to be abolishing duty on those topics. On those dutiable transactions. And they have reaffirmed that is what their position will be when in their, I believe, 2015-2016 budget. So got a month and a bit to wait. We'll hopefully see this happen. In terms of Queensland, I think probably our current treasurer said it best when he was doing a presentation to the REIQ in June 2015 when he said, let's just see there, stamp duty will not be abolished in Queensland because it generates more than $2 billion to the government each year. The Queensland state government is quite fond of stamp duty at the moment because in 2014-2015, they actually had a windfall with a really large transaction where I think they got a couple of $100 million in stamp duty. So the stamp duty revenues for 2015 for the Palaszczuk government were about $4.6 billion as opposed to the previous year when it was down to about 3.6 billion. And in light of that sort of revenue and that sort of windfall, it's unlikely. I suspect you'll be unlikely to see any meaningful changes to stamp duty in Queensland in the near future. What also probably more telling is whether or not the current state government has the political capital to be able to abolish, say, a current stamp duty for a broad-based land tax. That seems to be the position that they're adopting in South Australia, at least on commercial building stock. But it's just hard to see that happening up here anytime soon. If there's an economic downturn, I think when the GFC came through, most states saw it, that all of their stamp duty revenue dried up because people weren't transacting. Then you might see another rush or another push for a broad-based land tax. But until that sort of thing happens, I think we're stuck with stamp duty in Queensland for a little while. So again, stamp duty in Queensland is probably going to stick around for land transfers, business asset transfers, trust acquisitions, and landholder acquisitions for the foreseeable future. We'll just quickly spin through some of the recent tax changes. So I think as I told you previously, the Turnbull government announced in their recent budget that they're going to increase the turnover threshold for small business entities from $2 million to $10 million, or the turnover test for small business entities, just to apply from 1 July 2016. Unfortunately, it's not going to apply to the small business concessions. They're going to continue to adopt the $2 million turnover test for applying the small business CGT small business concessions, which is a bit unfortunate. But it does give you the ability to go ahead and apply those things like this new restructure relief, the lower small business corporate tax rate, accelerated depreciation, and also the depreciation foreign provisions for small business entities. The other one of late that has come through was, for a while, you used to be able to structure a trading trust by having a super fund, so a self-managed super fund, owning 20%, at least 20% of the interest in that trading trust. And what that meant was it would be considered a public trading trust, taxed as a company, but also used to get the general discount for capital gains tax purposes. Government didn't like that, so on 5 May, got delayed a little bit when it got prorogued when Malcolm Turnbull pulled everyone back so he could call this double dissolution election. So it finally got assent on the 5th of May 2016, so it applies. It's set to apply from 1 July 2016. If you've got any of these public trading trusts, because a super fund owns that 20% interest, you've got effectively 2 years to run out all of the franking credits on it, and it's no longer going to be considered a public trading trust. So just some changes to be aware of. And the final thing, probably just to cap it off, is that some of the changes that are discussed here today might not yet actually happen. A lot of the budget measures, in particular, between Liberal and Labor, differ. So we have to wait until 2 July to see who wins the election. And depending on who wins the election, we'll be talking about what the tax changes for this coming year are going to be. Just as a quick comparison, Liberals there have set out a reduction, obviously the company tax rate, down to 25%. Labor said no, they're not going to do that. Liberals have announced some changes to the super amendments. I think there was $1.6 million capable of supporting a pension, plus changes to lifetime limits. Labor, when I last checked, current policy was you get 75 for assets in pension phase. I'm going to tax it on the way out. At anything over $75,000 coming out to anyone in pension mode. No changes to, so Liberals are saying no changes to negative gearing. Labor is still flirting with the idea and is still pushed out. I believe when I last had a look, they were going to remove some of the interest deductions for geared assets. At least that's what was on their 100 positive policies when I prepared this presentation. There seems to be some, I was reading an article earlier today, which seemed to say that they might be paring that back a little bit. But we'll have to wait and see, obviously, as these policies develop through the election campaign. This might change, might pare it back, and the rest of it. The other thing is Labor, in their 100 positive policies, have set out that they want to reduce the CGT general discount from 50% to 25% from 1 July 2017, and the Liberals have said no to it. So that's pretty well a wrap up of some of the more recent changes to tax, and particularly tax that are going to be affecting small business entities in the coming years. You can put in down below. Thank you. All right,